Good morning and welcome this morning to Long Verticals and Diagonals, another great webcast from Schwab Coaching. My name is Ben Watson. I'm an education coach and senior manager here, and I am joined out there in the chat by my good friend, Michael Fairborn. Michael Fairborn is going to be out there to help out answering questions about this specific class, but he is a phenomenal educator in his own right and a 20-plus year veteran of the financial markets. By the way, thank you to all of you for being here. Whether you're here in the live version or in the recorded version, doesn't matter. We're glad to have you here. You get to ask questions here in the live version, but if you're watching in the recorded version, please leave us your comments, and we'll get back to you as quickly as we can with the answers to those questions and comments. So we're going to jump into the question of long put verticals and long diagonals this morning, taking a bit more of a bearish approach to the market, or at least a downside move approach to the market. This comes at a specific request from some of you in our feedback surveys, so we're going to answer and take care of that request for you. We're going to jump into that here really quickly, but we've got to take care of some quick housekeeping items first. The first one is this reminder: everything we talk about is simply for illustrative and educational purposes only. It is not a recommendation or any kind of an endorsement of a security or a pattern or strategy. Remember that options carry a high level of risk. They're not suitable for all investors. Make sure that you understand the characteristics and risks of standardized options before considering any option strategy or transaction. Remember that multiple leg option strategies will involve multiple commissions, and spread trading, like what we're talking about today, must be done in a margin account. Also, remember that anytime you're short an option, and when we talk about these spreads today, we're talking about a short leg and a long leg at the minimum. Anytime you're short an American style option, there's the potential that that short leg could be assigned early. Now, as we jump into this discussion, I'm going to remind you that this is in the thinkorswim desktop software platform. We're going to be using the paperMoney side. That's not a guarantee of future success out there in the real world. It's a great learning environment, but it does not facilitate that early assignment of short options. When we're talking about long vertical spreads and long diagonals, that early assignment is something that can actually, in fact, be beneficial to us. So we'll talk about that concept as well. Just remember, as you move your practice from paper trading to live trading, things may behave differently. Now, we're going to use technical analysis in this discussion. Schwab doesn't recommend the use of technical analysis as sole means of investing research. Now, one other thing I'm going to mention here is the discussion about stop orders. We typically don't use stop orders in these types of strategies. However, if you do use a stop order, whether it's stop order or a stop limit order, remember that you can specify the activation price, but not the execution price. And in the event of a stop limit order, there's the possibility that that order may not even fill. So we'll keep that in mind as we look at this. Remember also, of course, past performance and security or strategy does not guarantee future results or success. So let's jump into our discussion here really quickly with this kind of overall mindset. We're going to look at long vertical and diagonal strategies. Specifically today, by request, bearish strategies. We're going to discuss the impact of price, time, and volatility. We're going to put on some example trades to illustrate those concepts. So once again, thank you for your suggestions and your requests out there in the feedback surveys. We might have one of those today. We'll see if we get a feedback survey. If we do, we certainly ask for your help in filling that out and letting us know what we can do to make these sessions better. Let's talk a little bit about long verticals and diagonals. Remember that long vertical spreads are generally in the same expiration month, just two different strike prices. Long put verticals have a long put and a short put and are in the same expiration cycle and expect bearish movement. Long put diagonals, on the other hand, have two different expiration dates. They have a long dated put option, and that is generally our long option. And they have a short dated put option, which is generally our short leg. Confused yet? So when we talk about long and short, in that case, I'm mixing the metaphors. But when we talk about long and short, when it comes to buying and selling. Remember, when we say the word short, that's an option that we are selling. When we say the word long, that's an option that we are buying. So keep that in mind. Now, when we talk about long dated now or short dated, now we're talking about expiration. So in a diagonal, we're going to have a long and a short and a long and a short. One's going to be buying and selling. One's going to be expiration date. So keep that in mind. Again, hopefully you're not confused yet, but we'll try to work through that as we go through this discussion. I'm going to switch over to the thinkorswim desktop software platform. We're going to take a look at what's going on in the market today. And again, good opportunity for me to remind you to click on that subscribe button down at the bottom of the page if you have not done so already. That's going to keep you updated on new content. It's at no cost to you to click on that subscribe button, so you don't have to worry about it becoming recurring charge. So thanks for being here and clicking on that subscribe button if you've not done so. Let's take a look at what's going on in the market as a whole. So I wanted to kind of preface this really also by saying this, because I know that there are a number of you who are brand new to this discussion, and certainly welcome and we're glad to have you here. But I wanted you to think about this in the context of steps that you could take to make a decision if I weren't sitting here with you and explaining it to you, right? What could you do when you go home or when you turn the webcast off, and how you try to replicate this discussion and this process, right? So the first thing that I do, and you'll see it in all of the webcasts that I teach, the first thing that I do is I look at the market as a whole and kind of get a directional bias for myself. And that's what we're doing here in looking at this approach, right? So looking at the S&P 500, I'm getting a sense of what my directional bias is. And overall, the S&P 500 is still in a bullish uptrend, right? It's still making higher highs and higher lows, right? And as we start to look at these moving averages here, those are both moving higher. We start to see a little bit of a breakout yesterday, but it's pulling back. So we're not overall bearish, just maybe situationally bearish, right? Our situationship here is that maybe price moves back down to a level of support. Failed to make a new higher high today. It made a new higher high yesterday, but today it's pulling back a little bit. Perhaps a wait and see, doesn't, whatever the reasons are, that's what's going on. Market is kind of sitting right there below that previous high. Okay. Same thing with the NASDAQ. We saw a little bit of a gap down and it's rallying just a little bit, but it is not blowing the doors off of things to the upside in the tech heavy NASDAQ. Maybe a little bit of wait and see today for things like the Tesla robo-taxi event that's going on and things like that. Plus, we've got a lot of tech earnings coming up in the next few days. And the Russell 2000, the small caps, seeing that move to the downside with a little bit more bearish bias to the RSI. So a little bit more bearishness there. So my thought was, let's look for opportunities that are moving in a bearish direction. Okay. So Tom and Mike, hang on to those questions as we get into the construction of these trades. I will address both of those. And if I don't come back to them, please remind me, and I'll have Mike remind me as well as we get into those questions about expiration and when during the day that we might put those trades on, right? Or take those trades off. So the next thing that I do in my process is I go over to the grid that I've created that looks at the volatility, right? This is the VIX grid that I use. So I want to see what volatility is doing. And volatility, the VIX, the volatility of the SPX is kind of sitting right about this 20 level, 2076 level. Today, it's not really falling, nor is it really rising. It's kind of in stasis, and that's maybe to be expected as the market kind of sits and spins at that little bit of a resistance level, right? Not at all unusual at that particular point, but we've had rising implied volatility. We can see that the 30-period average of implied volatility has been rising, and implied volatility is relatively higher than its average. So we're in a relatively volatile period. So then the next step that I might take is I might look through any number of watch lists, whether those are personal, whether those are public watch lists, and look for some of these perspectives, right? Look for some of these moves that might be happening to the upside or to the downside. Now, this happens to be a watch list, one of my personal watch lists, which is my bear flag scan. I teach a class on Tuesdays called Trading Flag Patterns, where I look for bullish flags, I look for bearish flags, and I've built scans for both of those. And I'll share this particular one. We'll go to the scan tab here really quickly. I'll load up that scan. We'll load up that bear flag scan. And we can run that scan and we can see some of those results. By the way, that's the dynamic list. I'll go ahead and share that scan so that you've got that bear flag scan. I'm going to ask Mike if he wouldn't mind going out and grabbing the link to that webcast or to that playlist, the flag pattern playlist, so that we can put that out there in the chat. But remember, anything that we share, any of these grids or any of these scans, those are for illustrative and educational purposes only. They're not guaranteed as to time or accuracy, right? So because I've got a little bit of a short-term bearish bias, this is where I'm going to go and look for opportunities to trade bearishly. Now, rather than spending our time looking at these individual stocks, I've already done that for us. I kind of scanned through some of these stocks and I looked for some circumstances that presented themselves as circumstances that might let us take advantage of bearish direction. The first one that I came up with was Ulta, ULTA. And again, remember, not a recommendation. I just wanted to use this as an illustrative example. So I'm going to go back over to my charts and I'm going to go over to my single grid, which I've created as just kind of a playground here, right? And we're going to bring up ULTA, Ulta. And so what I've been noticing with Ulta is that overall, the last kind of 2 or 3 quarters, this has been moving in a bearish direction. And in fact, it's bounced down from a resistance level. It's kind of breaking down below a support level here. Maybe a little bit of an upward move today, which might not be such a bad place to get into this trade from that standpoint. Thank you, Mike. I appreciate you doing that. But looking for continued bearish movement, right? We've got some support down here. We've got some support down here, expecting that bearish trend to continue to the downside. Now, the other thing that I want to look at and add to this list or to this particular playground at the moment is implied volatility, IMP, implied volatility. And I'm going to choose the implied volatility study and add it to the chart. And one of the things that I notice is that implied volatility is relatively low at the moment and generally on the rise, right? So if I were to draw a little bit of a trend line, it's relatively low, and on the rise, it's not as high as it's been. And that makes sense because I've got an earnings announcement coming over the horizon here, right? On the 5th of December. Boy, that doesn't look very far over the horizon, does it, right? We're going to be at the end of the year. We're going to be at the holidays before we know it. But my expectation is that the price of the stock is going to continue to move to the downside in this particular case, right? And implied volatility rising. So let's think about this. When we put together a long vertical spread, we've got 2 legs. Remember, I suggested that we had a long and a short and a long and a short, right? If it's a long put vertical, that means we've got a long put option. Now, I'm just going to throw it out to you as a kind of a rhetorical question. Does rising implied volatility benefit long options? Yes or no? Does rising implied volatility benefit the buyer of a long option? Yes or no? What do you think? So think about this. If I'm buying a long put to take advantage of that downside movement, okay, this downside movement, then, right? See, there we have it, right? The buyer of a long option benefits from rising implied volatility. Right? Benefits from rising implied volatility. That rising implied volatility is working for us as the buyer of an option. As a seller of an option, no, it's working against us, right? But it's working for us as the buyer of an option, right? So think about this. If we go to the trade tab here for Ulta, and we were to go out, let's say in this particular case, we don't want to be all the way to the earnings announcement. Let's say we go out here in this particular case to about 29 or 35 days. Let's go to the 15 November expiration here, okay? And what I want to do is I want to change my layout to Delta, Theta, Vega, okay? If we're the buyer of an option, I want that option to end up in the money at expiration, right? And I want to see it gain value, okay? So if I were to buy a put option, and so I'm going to be over here on the right-hand side, and I want to buy a put option. Let's say I buy the 370 put, and I'm going to pay $20.40 for it, right? And if I click on confirm and send, and I read through this, so if the price of the stock goes down, that benefits me because this option is going to gain value if the price of the stock goes down, and if implied volatility goes up. And the stock can only go to zero, so I've got a maximum theoretical gain in this trade, but it's going to be relatively expensive. This is $20.50 per share times 100 shares. So in fact, $2,050 per contract to take advantage of that downside move. And it benefits for every percent gain in implied volatility, it benefits by about 45 cents, right? Benefits by about 45 cents per percent of increase in implied volatility. So yeah, it's going to be positively impacted by that rising implied volatility, okay? So let's see how we turn that long option, however, into a long vertical. Because remember, our expectation is that the price of the stock is going to continue to move to the downside, and we want to take advantage of that, but this is relatively expensive. So we've already put in place this long put option, right? We haven't bought it yet, but we've just kind of created that order, and we know what that's going to cost us. That's a defined risk. That's the maximum amount that we could theoretically lose in the trade. But here's what we're going to do to now create this as a long put vertical. I'm going to go to an at the money or a slightly out of the money put option, and I'm going to sell that put option. So we're going to be short that one. We're going to be long the one that we just looked at, right? So long the 370. So notice that the price of the stock is currently trading here at 362. That means that my 360, 365, those are kind of equidistant from the current price of the stock. I'm going to go with the 360. That's slightly out of the money, right? The stock's got to go down another 2 points for that to start being in the money. But I'm going to sell that one for $14.90. So if you look at what I just did, I created a $10 wide spread between those strike prices. And for that, we're going to pay $5.10, not $20 a share, but $5.10 a share. You know, here's the thing. What we've done is we've capped, theoretically, the maximum gain in the trade because this spread cannot trade more, can't be sold for more than that $10 width in the spread. But this is our maximum amount that we could theoretically lose in the trade, right, is the $5.10 that we're paying for it. So if we now click on confirm and send, we see another number here. It's that maximum profit. So the maximum theoretical gain is $490, maximum theoretical loss in the trade. If it were to completely go against us and both of these legs were to expire worthless, our maximum theoretical loss would be $510, right? Does that make sense so far? Okay. So now as we put that trade together, now what we're looking at, let's come back down here and let's right click and analyze this trade, right? And here's our expectation. Now, remember, this graph shows profit and loss over here on the left-hand side and stock price down here at the bottom. So here's the thing. Our maximum theoretical gain comes if the price of the stock moves to 360, where our short strike is, right? Where our short strike is. Maximum loss comes anywhere above 370, because that's where both legs would be out of the money. And if we were to stay there till expiration, that would be the case, right? We would lose everything in the trade because those legs would expire worthless. Now, here's the thing. And to get back to Tom's question, right? What if the price of the stock made a big move down right away? Would we have to wait to close that trade down like we would, say, for instance, a butterfly spread or a calendar spread? And there is the possibility that we could eke out a little bit more gain if the price of the stock were to move to the downside and we were to let this go all the way to that expiration point or very close to that expiration point, and both legs were to expire in the money. But here's another scenario that might happen, is if the price of the stock were to make the move to the downside quickly, an option buyer might choose to exercise their right to sell the stock at 360, and we might have to satisfy that obligation. We might get assigned early, but we have the right to sell the stock at 370. So in the case of early assignment in a long vertical spread, that actually works in our favor, because we're now in a situation where we could theoretically capture maximum gain in the trade prior to that expiration point. Okay. So to Mike's second question here, what about skipping strikes? Do we skip adjacent strikes, or do we go wider strikes? I'm going to do this really quickly. Watch what happens if I go deeper in the money on my long leg. All right. If I go deeper in the money on my long leg, now what's going to happen is the cost of the trade is going to be more, but my width of the spread is going to be wider. Right? So now we're talking about 20 points. And so my maximum gain is going to be relatively higher, absolutely higher, but relative to what we're paying for the trade, it's going to be about the same, right? But it gives me a wider range of some gain, some loss here. Now, let's go back to our original 370. What if I were to go further out of the money with my put option? What if we were to go to, say, for instance, the 350? Now it's going to cost me more, and it shifts the vertical spread to the other direction a little bit, right? The stock has to move more in order for this trade to become maximum theoretical gain. So we're going to go back to our original numbers here. And I like the question that Robin asks: how close to expiration could you be assigned? Is it any time during the trade or close to expiration or at expiration? The assignment possibility is what scares me about the vertical spread. So here's the thing. That possibility exists all the time, anytime you're short an option. But the likelihood increases the closer you get to expiration and the closer that option, that short option, is to having no extrinsic value or no time value left. Okay? But here's the thing. In a long vertical spread, as opposed to a short vertical spread, a long vertical spread, because we have a right that gives us the opportunity to satisfy that obligation, and exercising that right to satisfy the obligation puts us into a situation of maximum theoretical gain. Early assignment in a long vertical could be considered to be a good thing, not a bad thing. And it's not a bad thing in any sense. You just simply have to know what it means and what it does for you, or what it obligates you for. Does that make sense? Okay. I'm glad you asked that question. And I think I saw that on another survey or another comment before was that kind of fear of being assigned. So in this particular case, as we put this trade together, looking for that move, and look, all the stock has to do is move now down to 360, and it's at 363 right now. If it moves down to 360, both of these legs are in the money, and now that trade is getting towards maximum theoretical gain, right? So here's what we could do is we put this trade together, right? We could say, fine, I know what the maximum theoretical gain on this trade is. Maximum theoretical gain, it shifted a little bit because the price of the stocks moved. Maximum profit on the trade is 505, right? So what if we were to do this? What if we were to say, look, I'm going to sell this trade if it goes to 80% of that maximum theoretical gain. So because remember, the most that I could sell it for is $10. So I could sell it for $9 or $8. Cool. Would that work? So let's do this. I'm going to change this order from single order to first trigger sequential, and I'm going to create an opposite order to sell this vertical spread at a limit price. If I can sell it for, let's just call it $8 for easy math. If I can sell it for $8 or more, great. Get me out of the trade anytime that trade sells or that trade is priced at $8 or more. So that means if the price of the stock goes down, if implied volatility goes up, if time passes, all of those things are going to work in my favor in this particular case. And I'm going to put this trade together and I'm going to click on confirm and send. Now, one thing I want to do before I do that is I wanted to point out the Greek sensitivity. For those of you that are that understand the Greeks, if you don't, there's a lot of great webcasts that we have in our webcast channel that talk about option Greeks, okay? But what I want to look at here is the sensitivity of this spread to various factors. So remember, we're looking at the 360 and the 370 strike. So let's look at delta sensitivity, directional sensitivity. We're long the 370 strike, right? So that's got 53 cents of delta sensitivity to the downside. That's that minus sign. But then we're short the 360, which has 44 cents of sensitivity, but that's working against us. So we're left with a minus 0.44. So that means we're left with about 9 cents or 10 cents of directional sensitivity. Okay, so this is sensitive. This has a delta sensitivity of 0.09. Okay, let's look at theta. How sensitive is this to the passage of time? Well, we've got the 370 strike, and we've got the 360 strike, and they have the same theta. So one's working for us, one's working against us. So this is theta neutral. Okay, this is theta neutral. It doesn't matter if time passes or not. Wow, we just eliminated the passage of time. We're almost to that share level of time control here. We're not turning back time, but we're stopping time, right? Okay. Now, the next thing is Vega. How sensitive is this to changes in implied volatility? So that's going to work for us, and that one's going to work against us. So guess what? This is Vega neutral as well. So the only thing that this trade depends on, with a delta of 9 cents, a theta of 0, and a Vega of 0, the only thing that this trade depends on based on this is directional price movement. How cool is that? Right? That's one of the benefits of putting together a long vertical spread in the way that we do and kind of managing those Greeks, is that we can use the sensitivities of our options to manage out the things that work against us. Now, here's the thing. Option Greeks are theoretical. Option Greeks are dynamic. And so this only exists as a snapshot. That might change. That balance might change at some point. So you got to pay attention to that. But at the same time, we're starting this trade with this expectation of directional price movement. Test user says, well, earnings are coming for Ulta. Well, this option expires on the 15th of this vertical spread expires on the 15th of November. And we know that earnings are on the 5th of December. So we're going to be out of this trade and done before that earnings announcement even happens. But what's going to happen? Well, what do we know? Implied volatility is rising. The price of the stock is going down. So we're taking advantage of directional movement. We've taken out the impact of implied volatility. And time is neutral. Time is at a standstill at this particular point. Okay? Now, here's the thing. Somebody's asking about the question, well, could we put a stop on this order? Let's go back to the trade tab and let's pop that order back up. Well, we could, right? We could put another stop order on this and say, you know what, I'm only willing to lose $4 or I'm only willing to lose about half of that debit that I'm paying. But you know what? This is already a defined risk trade. I know what that risk is. So here's the thing. Rather than putting a stop on there, which might not execute at the price that I want it to execute, I'm willing to say, look, I'm going to plan for maximum theoretical loss versus putting a stop on there, right? From a complexity standpoint, from a standpoint of, I don't know where that stop order is going to fill, and from a volatility standpoint, I know that sometimes option prices can move around a lot. So I want to get out if it goes in my direction. I don't necessarily want to get out if for some reason when the market opens up on a particular morning and prices move down, but then they quickly come back. I don't want to get stopped out and have the trade go in the direction that I want it to go. So I'm generally not going to manage or protect the downside risk in a long vertical spread. I'm simply going to use the net debit as my max theoretical loss, and I'm going to plan my position size around that max theoretical loss. So if that answers your question, Jerry, in terms of putting a stop loss, generally not. Okay. So here's the thing. Mike asks the question, do we generally need to be closer to expiration to approach maximum payout? So let's go back to our Analyze tab here, and let's look at this particular trade. So here we are at about a $5 debit. The purple line is our max theoretical gain today, right? Or our profit and loss today, okay? So as we look at the date going forward, right? So let's advance our date. You can see how that line shifts. So we're going to advance towards expiration. You can see how that line shifts. So sometimes long vertical spreads can be slow. This is just assuming the passage of time. Remember, we've taken theta out of the equation. So we don't really have to wait. We can wait. So there's expiration to get to that maximum theoretical gain. But let's take that back to today. And let's say, what if the price of the stock made a move here? Whoops, let's maybe open up this and let's make the stock price move instead. Now watch that purple line. If the stock price makes a move to the downside, if the price of the stock moves down, then that's going to shift pretty quickly, right? Because we don't have a lot of extrinsic value left in this particular trade, right? We don't have a lot of extrinsic value. As a matter of fact, let's calculate that. Let's go back to the trade tab. And before we send this order off, let's change our layout to intrinsic and extrinsic. And let's see what we've got. So extrinsic value in our 370, we've got about $12. And we sold about $14 of extrinsic value. So we're actually pretty much extrinsic value neutral, right? So realistically, if the stock price makes a move or we get assigned early, then we're going to get closer to max payout. We don't necessarily have to wait till closer to expiration. And this is where, again, selection might be, or expiration selection might be consideration, right? So thinking about events as opposed to a maximum duration. Now, the longer we stay in that trade, the more opportunity there is for the stock to move against us, right? But there's a balance always between length of time in the trade versus the probability of success in the trade. So if we were to go to 0 DTE, or if we were to go to a closer DTE, let's go to the 18 October and let's put the same trade together, right? So let's look at 370, 360. Let's just put this trade on really quick. Let's fire this order off really fast. So I'm going to click on confirm and send, read through this order, make sure that I'm aware of the transaction costs and any alerts, and I'm going to fire that order off. And then we'll put together another order here. We're going to buy the 370 and we're going to sell the 360. And that's actually going to cost us a little bit more, but has about the same. So, there are maybe some benefits, right? Less time for the stock to move to the downside the way that we want it to move, but also less time for it to move against us. So again, that's that balance that we've got to think about with 8 days to go until expiration. About the same price, maybe a little bit more directional sensitivity, but also perhaps a little bit more theta sensitivity as well, right? So those are all the considerations. Now, let's take a look at this in terms of a diagonal. So let's go back over here to the chart and let's say, what if my expectation was that the price of the stock is going to continue to move to the downside? And rather than doing this in one expiration month, what I'm going to do is I'm going to look at selling an option. Let's say we sell the 360 strike here in the 8 November expiration. And instead of buying the long strike, there goes our vertical. Instead of buying the long strike in the same expiration, I'm going to go out a few more expiration cycles. Let's go out to, say, for instance, the 20 December. And I'm going to buy, in this case, the 370. So notice what I've created now. I've created a diagonal spread. $12.55 debit against a $10 wide spread. Unfortunately, that doesn't work really well, okay? Oh, yeah, good point. Brenda, thanks for catching that. I forgot to make that limit order a good till canceled. So I'll go back in and we'll change that, right? But now if I analyze this trade, when I take that vertical off, here's what I've got. I've got an upside move towards my maximum theoretical loss. I've got a downside move that gets the max theoretical at that price, at that short strike, right? The 360 strike, and then tapers off from there. So if I were looking at this as a one and done, my expectation might be looking for this price to get to that 360 level, right? And not really go higher. If I were looking at this as the possibility of rolling, right? We go back to the chart and I say, look, I'm selling the 360 and I'm buying the 370. So there's about the 360. Here's about the 370. Okay. So if the price of the stock continues to move lower, let me grab my magic marker, then I might buy that one back and then sell another one, and then buy that one back and sell another one, and still keep that expectation moving to the downside, because I've got that long put option that's longer dated to go until expiration. That allows me to stay in the trade with that trend for a longer period of time. Does that make sense? Yeah, actually, I think, though, let's go back really quick. Good question, Jim, or JM 460. Let's go back and to the trade tab and let's look at those, right? Here we are out at the December, 71 days to go until expiration, $26.20 by $26.60. 40-cent bid ask on a $26 price option. That's not too bad. That's a pretty tight bid ask spread for that price. As a matter of fact, if we get down here to that 15 NOV, depending on the expiration or depending on the strike, we're looking at 1420 by 1470, and we're looking at 1910 by 1960, so 40 or 50 cents, right? So Alan asks the question, is there a situation where you might want to leg into a diagonal from, say, for instance, a long vertical spread? And the answer to that is absolutely, yeah. If you see, so let's take a look at another example here, all right? Let's take a look at something like Merck. Let's go to the chart here and go MRK, Merck. And Merck is continuing to move to the downside, right? So Rob Indy, this is going to answer this particular question as well. You can continue to roll both legs, but the idea behind a diagonal generally is that you keep the long leg, the one that you bought, and you roll the short leg against it to keep paying down the cost of that long leg. So let's put this together first as a vertical right here on Merck. Let's go to trade. And let's say, look, we're going to go out, for instance, to the 15 Nov expiration, and we're going to sell the 105. It's currently sitting at 109, so it's got to move a little bit. We're going to sell the 105, and we're going to buy, say, for instance, the 115, 15-cent bid-ask spread, right? So we click on confirm and send, 528 max loss, 472. So here's the thing. As this trade continues to move, we could roll this leg right here, the 15 November expiration long put. We could roll that out to a longer dated put, right? To make this a diagonal spread. And then continue to stay in that trend. What if we said, hey, you know what? I think this downtrend is going to last longer than just the move to the 15 November expiration. So what I could do is once I've placed that trade, I could roll this leg, the long leg, out to, say, for instance, the 20 December expiration, right? And roll this into a diagonal, right? So let's make that back down to the 15 Nov, and now we've created this as a diagonal spread. It's probably going to cost a little bit more, right? Okay. So we could put that trade together and moving in that direction, right? Now, would you ever change a long diagonal into a short diagonal? Not necessarily, right? And there are, and that's a good question, Jam460, because there are trade repair strategies that talk about kind of reversing that scenario. If you've got a bearish trade, reversing it into a bullish trade. And I think Mike will agree with me on this one. I'm a much bigger fan of simply closing down the trade that you have if the trade is going against you than trying to morph it into something that it wasn't to begin with. Because I think you get better results in taking a trade that's moving in the direction that the stock is moving and is intended to take advantage of that, as opposed to trying to apply some kind of patch or repair strategy to a trade that's not working in your favor. Does that make sense? Try it out and see what you think. Okay. Now, Agrabah asks an interesting question. When price bounces off of support or resistance, you apply a credit strategy. If it breaks through those levels, you use a debit strategy. I think there is some element to that. But at the same time, I think it's more about direction and expectation. If you have an expectation, Agrabah, that the price of the stock is going to move, then a long vertical strategy may make more sense than a short vertical strategy. If you have a circumstance where you think the stock may move, but it may also move in a neutral fashion, then a short vertical strategy may be the more appropriate strategy in that particular case. And Mike, thank you for reminding me of the question, right? Would it be better to open our trade near the close of the day prior to waiting until the next morning when volatility may be higher and less desirable fills? Yeah, here's the thing. Traders, institutional traders, option traders are human beings. And so they're going to take lunch breaks, right? but they're also going to revamp and rebalance things as you get to the opening of the day and the closing of the day. So you see probably the most volatility. If we were to look at, let's go real quick. I'm just going to do this really quick. If we were to go to the VIX and we were to put this on a 1 day, 1 minute chart, you're going to very likely see the greatest amount of volatility occurring at the open and near the close, right? Greatest amount of volatility at the open and then near the close. So one thing that you might think about to let things kind of normalize is putting, especially spread trades on where you're talking about 2 or more bid-ask spreads, putting those trades on in the middle of the day when volatility and bid-asks have kind of narrowed and normalized and stabilized for the day, as opposed to trying to put those trades on during the big volatile periods, right? Does that make sense? Okay. Yeah. So Rob Indy, in this long put vertical spread that we were talking about with Merck, right? Whoops. Let's go back here to 1 year, 1 day, and let's make that back on Merck, MRK. In that long put vertical spread, we're expecting that trend is going to continue to move to the downside. And so we would roll that and do it again and do it again, roll the short leg and do it again and do it again, like we talked about with our previous trade. Guys, hey, we are out of time. Wow, great stuff, guys. Thank you very much for all of your attention and discussion today. Great conversation. Check out Trader Talk's webcast channel for more information about option Greeks. My thanks to Michael Fairborn for helping out with this, and my thanks to our great production staff for helping with our discussion today and keeping this webcast going. You guys are phenomenal. We'll see you again very soon. Remember to follow us. Click on subscribe. Follow us on X. We'll see you again very soon. Take care, everybody. Bye-bye.